VC funding is the very last thing that I would ever take. It's close enough to private equity that I'm like, yeah, I don't think so. I see lots of VC funded businesses in our space, and sometimes it works really well. I think probably less than 1% of business VC's a perfect fit, where you've got a massively potential high growth business, you've got product market fit, all of your ducks in a row, and you need loads of cash in order to swing for the fences. I think there are loads of businesses where they would be better served by bootstrapping for the initial part of the journey if they can, and I realise I'm in a privileged position because I've had an exit that I can bootstrap forever, frankly, and then do an angel funding round and then find profitability and get that more steady and sustainable growth. And for me, that's a much more comfortable journey.
I'm Hattie Willis, your host, and each episode I talk to an entrepreneur, investor or startup expert to unpack their hardest moments, biggest wins and hard-earned advice so we can shortcut our learnings as founders together. Have you ever found yourself drowning in fundraising legals and language? This is the interview you have been waiting for. In this episode, I'm joined by the brilliant Sam Simpson, co-founder of FounderCatalyst, who is on a mission to simplify and accelerate the early stage investment journey. Sam's not just talking the talk, he's walked the walk, having co-founded and exited several tech startups, including the 17th fastest growing company in Europe in 2017. Oh, and did we mention he took that company from naught to £27 million in less than 4 years? But Sam's not just a founder. He's also an active angel investor with 32 investments under his belt in just 6 years. Plus, he's a sought-after board advisor. In other words, when it comes to navigating the minefield of fundraising and investment, Sam's who you want to learn from. In this episode, we discuss simplifying the early-stage investment legal journey, insider tips on SEIS, EIS and equity investment, strategies for finding the right investors for your startup, lessons learned from co-founding and exiting successful tech startups, how to think about valuing your early stage startup, and what Sam looks for as an angel, as well as what really puts him off, even on a seemingly great deal. So whether you're a first-time founder trying to wrap your head around the legal jargon, or a seasoned entrepreneur looking to optimize your fundraising game, this episode is packed with actionable advice and hard-won wisdom. Don't miss out on this incredible opportunity to learn from one of the people I trust most in this ecosystem. So firstly, Sam, welcome to the show. It's a pleasure to finally have you on after we've been talking about this for a year, maybe?
I think so, yeah. Absolute pleasure to be here. I listen to this religiously every week. I won't listen to my own, obviously, but I listen to your podcast every week. So it's, finally great to be here.
Oh, it's super exciting. So I want to get into your story first, and then I know that listeners are going to have a ton that they want to understand, both from the side of what FounderCatalyst does, helping startups think about what you need to worry about with startup legals and SEIS and EIS, which are tax schemes that we'll come on to. If anyone doesn't know what we're talking about, you will later, I promise. But I really want to start with how you got into entrepreneurship, how your journey has impacted you continuing. So let's start with your first foray into entrepreneurship. Can you tell us how you begun?
Yeah, sure. So accidental entrepreneur through and through. I got to the age of 43 and hadn't even considered being an entrepreneur. So, very traditional, did a degree in computer science, started off a job as an engineer, worked through that company from engineer consultant, lead consultant. I was tech director on what would now be a £50 million project, which was fascinating and, game-changing for my career. Moved across into project and program management and kind of restarted there just for giggles. I was director of project services. This is all in the same company, by the way. So director of project services, had 130 PMs reporting to me and about £250 million worth of projects. And then in an instance, in a flash, that business disappeared overnight. I should probably give you the context, shouldn't I?
Tell us how. What happened? Every founder is suddenly sweating profusely at the idea of their business disappearing overnight.
And this was a substantial business, 2,500 employees throughout Europe, about 450 million in revenue, nearly got acquired by Dell. So, it was an amazing journey. It was a private equity backed buy and build. So they bought a dozen companies over the 15 years I was there. So I literally went from leaving university all the way through to being the age of 43 in the same company. And literally 27th of January 2013, that business virtually ceased to exist. The administrators were called in and it was good night from there. And that was an eye-opening process in as much as not something I'd ever want to repeat. But I think if it doesn't kill you, it makes you stronger and all that.
Yeah.
And it was fascinating seeing the administrators at work in the business. And it was an absolute fire sale. I mean, on the first day, the administrators were called in. There was a conference call. This is all pre-Zoom, by the way. But there was an old school conference call with 400 people dialed in. They were all told, you're redundant. There's no redundancy pay. We're not paying you for January, by the way, because we've got no money, which is, if you can imagine, there were people crying in the office because December's a ridiculously expensive month. They got to the end of January expecting to be paid on the 27th of January and didn't get paid. So no pay for January, no pay in lieu of notice, no redundancy pay, no nothing, no expenses, no bonus. It was a very exciting period. And, it was a glimpse into what can happen when businesses don't work out.
How do you go from there, which is like seeing everyone's emotions and the responsibility of failing something, to going, I'm going to start something.
Start my own business. What a great...
This looks fun.
I was kind of at a crossroads, I guess, and I still had no glimmer or inkling into being an entrepreneur, but I reached a crossroads where I interviewed for jobs at some very big names that I won't mention. I'll try and keep away from brand names during this interview, but some very big names in the IT industry. And it just didn't feel like that would be great for me. And then some of my ex-colleagues from the old business said, right, we're going to get together. We're going to try and, phoenix out of the ashes. We're going to try and build an IT business that we can be proud of. So I joined as one of the founding directors there. So one of four. Yeah. And it was an amazing journey. We went from 0 to 30 million in about 4 years. Don't tell anybody, this is a big secret, but we bootstrapped that. But I'm sure we'll come back to bootstrapping, which in light of what I do now is humorous to me. But we bootstrapped that business to 30 million in 4 years. And my co-founders, or two of my co-founders, decided they wanted to do a buy and build strategy. So borrow loads of bank debt, take on PE cash, and acquire and bolt on other businesses. You can probably imagine my appetite for that was zero, having been through the journey before. So I exited. We ran a process, then exited in September 2017, which was fascinating. And I fell in love. So here's a really good introduction to SEIS and EIS, which are my favorite things in the world. I fell in love with the tax incentive schemes because we invested in our own business via SEIS back in the day. And that meant that when I exited, I didn't pay a penny in capital gains tax. So it saved me genuinely millions in capital gains tax. All of a sudden, I fell in love with the scheme for obvious reasons.
And so maybe a good time to just briefly explain what is SEIS and EIS for founders who are thinking, this sounds weird. What on earth is it all about?
So they are tax incentive schemes introduced by the UK government well over a decade ago now to incentivise high net worths and other types of angel investors in the UK to invest in early stage startups. There are two schemes. SEIS is Seed Enterprise Investment Scheme. That is meant for maximum risk early stage businesses. And there are very strict rules around, there's lots and lots of rules, but there are very strict rules around where you can invest in SEIS specifically. So first 3 years from the date you start to trade, and only up to £250,000. But the tax incentives are amazing. 50% of your cash back, CGT exemption, capital gains tax exemption for your investors, inheritance tax exemption once your investors have owned the shares for at least 2 years, and loss relief as well. So if I put £10,000 into a startup, I'm risking a very small fraction of that as a result of the schemes. Then EIS is meant for later stage businesses. The loss reliefs are less, but you can take on much, much more investment under those schemes.
Can you still invest in your own companies with them, or is that?
There are ways, there's absolutely. It's written into the legislation. It feels like a loophole. It feels like some tax scam, but the legislation is such that you can get SEIS on something called subscriber shares. Okay. So if there are 4 founders looking to start a business, and this is the easiest way of doing it, there are other ways, but if you've got 4 founders looking to start a business, you will invest a certain amount of money to get 25% of the shares, say. You're below the 30% limit in the legislation, and you can make use of SEIS by investing in your own business. Now, it is by no means that straightforward, but that is the distilled version. So it absolutely is possible.
And so, like you did, actually, it's one way for founders to actually get some real tax breaks if they invest themselves, but also, obviously, as you touched on,
it's a massive driver for investors to take that risk in you as a founder. So often I think in the startup ecosystem, you'll start to hear these terms because investors will say to you, if you don't know what they are, they'll say to you, have you got SEIS allowance left? And you're thinking, come again, what? And it's about them saying, basically, you have this very fixed amount that you can give out to investors, 250,000.
Yep.
They want to know, can I get some of that? And because it gives them this insane, so it's something like 27% of their investment they risk.
28%, 27.5%, but close enough. Well
Remember
remembered.
that from one of your introductions, Sam.
Yeah, so you're genuinely just risking 28% of your investment, and you've got unlimited CGT relief. So to give you an example, this has never happened to me, by the way, but I'm still waiting. If I put £10,000 into a business and it gets 100 times return, so somebody turns that into £1 million, there's not a penny of tax to pay on that. With loss relief on the downside. So lots of investors, they're very much focused on the upfront tax relief, getting half of your money back, and which is all well and good. But actually, what you want is your portfolio to do well, and then benefit from the CGT exemption as well.
And I think often tax relief is not known for its kind of grippingness, but as founders, I think it's something that is so exciting, particularly in the UK ecosystem. Sorry if you're listening outside the UK, we're just talking about an incentive for UK investors investing into UK companies, but it is incredibly exciting as a lever to convince people to put money into those really risky companies. Otherwise, you're just risking, the chance of failure is so high. Why would you do it unless your friends, family are fools, as we like to say? The
difference of SEIS is making you investable or uninvestable genuinely. I was on a different call this morning, and we were talking through the investments that me and the other guy presenting had, and between us we had 60 investments. Only 1 out of those 60 were outside of the SEIS and EIS scheme. So if you're not offering the SEIS advantages for whatever reason, whether you don't know about it or you haven't got to it yet, or your business is exempt for some reason or another, or is excluded, then it's really an uphill battle, because 99% of investors will only invest if you're offering those tax incentives.
And so you really benefited from SEIS.
Yes, personally, yes.
Personally. And you have this exit where presumably life-changing sums of money if we're talking about saving millions on capital gains tax. So, retirement beckons. You're ready to, take it easy. What was it? I think you said your prospect was the golf course.
Yes. Yeah. So I'm no good at golf, so that didn't happen. But I did lots of cycling events with good friends, and probably visited every Michelin star with 2 stars or above in the country.
Very nice.
And just had some fun. And then I think I still had some entrepreneurial fire in my belly, and I realised I couldn't play golf for the rest of my life, and I needed something to keep me out of mischief for another decade or whatever it happened to be. So I started angel investing, and I absolutely love angel investing. I love supporting entrepreneurs in lots of ways. Unfortunately, I can't support them all with money because I've only got a limited tax relief to offset first world problems. But so I've got 32 investments over the last 6.5 years, and really enjoy it. And I guess that leads on to why I started FounderCatalyst. I kept going to loads of pitch events back in the day, pre-COVID, when they were a real thing. But lots and lots of pitch events, and I'm going to name drop one of the people I ended up invested in. There's a guy called Tristan who literally, he is, his founder bingo. Every investor would want to work with him. He's got a PhD in AI before AI was this trendy. Part-time lecturer at UCL, hedge fund trader. He had built a platform to do commodities forecasting using AI, and he'd built a team ready to go. So, now that business would be ridiculously investable. This is pre the AI wave. I bumped into him at a government and Google-sponsored pitch event, and I think I literally threw my checkbook across the room and said, "Take my money, Tristan." And anyway, I took him for a beer afterwards and said, "Look, can I see your term sheet? Do you have SEIS advance assurance? What's your pre-money valuation?" And he said, "I'm going to stop you there. I've just got no idea what you're on about." And actually, something dawned on me there. I'm like, there's something wrong with the ecosystem where somebody who is so bright and so well placed, you would expect him to understand the ins and outs of this stuff, and he just didn't have an idea. He just didn't understand where to go. So I rolled my sleeves up and helped him do a funding round manually, and of course I invested myself because he was I got to know him really well, and great that he's one of my 32 investments. And that happened a few times. I thought, well, actually I'm going to do something more systematic about trying to fix this and lots of other challenges. The more you scratch under the surface, as you do in all of your episodes, actually, the more you scratch under the surface, the more challenges you find in the ecosystem. And the injustices really grate with me. They really don't sit well with me. So I started FounderCatalyst on that basis.
And definitely keeping you busy, because there is a standing joke between me and Tim, my co-founder on If We Raise, that he thinks still that you're AI, because the response rate is insane. And one of the things I always get as feedback from founders, this is not an ad, by the way, it's just genuine. One of the things that founders always say to me is, oh my gosh, she's so responsive. And I don't know how you have time for it all, but you still see so many founders day to day. And it's really hands-on with FounderCatalyst. And one of the reasons I recommend it to everyone, because I'm like, the level of support you're going to get is just like, you're getting it from someone who is angel investing, who has deep empathy for what the investors want to see and pays it forward hugely. So love what you're doing with FounderCatalyst. I want to get into, I guess, some of the things that you've seen exactly on this theme, founders. And I think some of it is like, you've been in space longer than me. Even when you've been in it a few years, you suddenly think everything is known to everyone. And actually, there are so many things that listeners might be thinking. You know, you mentioned pre-money valuation.
Yes.
I'm also wondering what on earth. So what are some of the most common pieces that you see yourself teaching founders that you think people really need to understand, and understand maybe at a deeper level than the searched definitions? Because it's easy to look up what's a pre-money valuation. But I think what we often don't get to is, why do you really need to understand what can go wrong if you get this wrong?
Well, I think those are two different questions. The first is, there's assumed knowledge that everybody knows this, and actually people don't. And when you look into why lots of founders don't understand a certain point, it's actually because it relies on a whole stack of information. It relies on lots of knowledge stacked on top of each other. And lots of the language is unfamiliar, and there's lots of assumed knowledge. And everybody thinks the fundraising scene is actually ridiculously complex. And it is in a broader sense. You know, if you're going for private equity cash or VC cash, or you're using debt instruments, it's really complex. Within the UK, the thing I love about SEIS is that it turns the early stage funding round process into such a well-trodden path. Because it blocks off lots of avenues. There's lots of things like liquidation preferences and anti-dilution, lots of bits and bobs that you'll probably get to see if you ever get funded by a VC. But in an early stage, they're just not compatible with SEIS. So actually, the journey going from having a bright idea through to closing your first funding round should be ridiculously formulaic. And I think people make a lot of money out of making it more complex than it needs to be. And there are so many startup experts who are experts because it's seen to be much more complex than it is. But that journey from here to here, you know, ignoring the sales and marketing and building a product, all of those side hustles, but the actual journey to get funded is ridiculously straightforward. It was really jarring to me when I realized how straightforward it is. And it's not much easier on the other side of the fence as well. As an investor, I remember going to an Oxford Innovation event, which was my first pitch event. And I was lucky enough, I bumped into somebody who'd been angel investing for a decade, and he gave me a brain dump for an hour and a half. He just loved telling me his war stories and things. And I'm so glad I had that, because it's also opaque from an investor point of view.
So true. And if anyone is thinking of becoming an angel investor and listening, Open Angel is incredible, which is a really great resource into like, how do you become an angel? What do you wish you knew sooner? And it's an entirely free online resource created by another guest, Andy Aim. His episode's already out. So yeah, and you're right. I think this space where lots of people benefit from keeping it opaque and keeping it feeling overly complicated.
But there are some, I think we're going to come on to, there are some genuinely complex ideas. You know, how do you set your valuation, which is a fascinating topic. So whenever I spot something, I think, actually, you can't explain this in a paragraph or a minute video, then I love doing deep dive articles on a specific topic. And one of those we've produced recently is around valuation. When you get to VC level investment, there are lots of scientific ways of valuing your business other than just market demand. At an early stage, that doesn't exist. So I thought, right, I'm going to write an article on that. I did a brain dump, both of what I think, and also I've hoovered up what lots of other angels think during my travels, documenting how does an angel, when they look at an investment, what are the things that matter? And obviously the proportion, you know, personally, I massively care about team is my first thing I look at, and the last. But every angel will have the same 10 things they look at on every investment. They'll have different weightings depending on that person's experiences. And again, that's another article I love writing, because for founders, they're probably looking at it, they're going, I just don't understand how my angels are assessing my business.
And I do think it feels such a closed box, because understandably as well, a lot of angels, and I do think we need a little bit more empathy on this from the founder side, a lot of angels are struggling to give feedback for some reasons of like, they're just swamped. They're seeing a lot of debt. Depending on what level you're at with them, they might not have time to do your full pitch review. They also might not want to break your heart and tell you they just don't believe in what you're doing, because actually they feel it's just their opinion. There's lots of reasons you're not going to get to the heart of why an angel might be saying no. So I think it's quite helpful to hear. Maybe we start from that. Let's go into it sequentially. When you look at an investment opportunity, let's actually go before looking at a deck. What are some of the things that you see founders get right and wrong about outreach to angels?
Yeah, outreach is a really tough one. Ultimately, finding an investor for you is a numbers game. There are something like 250,000 angels in the UK. Thanks to Scribe Labs for that number, but that's the best estimate I've heard of how many angels in the UK. None of those investors will invest in every business. So some just love B2B, some love B2C, some only invest in SaaS, some only deep tech, some only late stage, some only SEIS. Every investor has their own criteria. So of those 250, you're never going to get 100% of those investing in any single business. So part of it is luck on finding that investor. And you can increase your luck by doing research into investors who love your specific field or something adjacent to your field. Obviously, you don't want to target an investor who's already got an investment in a competitor because they'll probably have a conversation with you and rip off all your ideas. Be very mindful of that one. But you do want somebody who has an interest somewhere adjacent to your space. And you've got to find the right investor who is investing at the right time. So every single year, every angel investor gets a lump of cash that they can offset against either this year, or you can go back a year under SEIS as well. But you're trying to find them when they've got their tax relief. And the obvious place to do that is in April, because everybody gets a new tax relief then. But sometimes people want to keep their powder dry. They'll sit on their hands rather than investing straight away. So it's just finding the right person at the right time, who ultimately, the key thing, and I alluded to this earlier, the key thing I need is to like the founder. They've got to pass the beer test. Do you want to go for a beer with them? And to give you a counter example to that, I bumped into, and I'm not going to mention names, I bumped into a founder once, listened to them pitch. And again, absolute investor bingo here. It was an AI automation. There was a really lovely green angle. It was an untapped market. So there was no solution in this space. It was AI before AI. Valuations got quite so bonkers. Everything about this opportunity made me want to invest. I heard the founder pitch and it was credible. And we got on a Q&A session with other investors. And the arrogance of the CEO just meant I walked away. I just couldn't bring myself to invest in that founder. There were other investors asking questions, and he would either, answer a standard politician stuff, either answer a different question because I guess he didn't have an answer to it, or would get very defensive and just really bad traits in a founder. And you think, well, hang on, you're going to have to impress customers. You're going to have to talk to, your job as a CEO is selling to us as investors, but also selling to your own customers. And I walked away from that. And I wasn't surprised to see, I checked in a couple of years ago and that business had disappeared. They hadn't succeeded, even though on paper, it was a lovely opportunity.
And what are the, good signals? Are there some good examples? For instance, I often think around, and I don't invest, but when I meet founders that I want to keep supporting, it's around like the coachability. If I give you a little bit of advice, what do you do with it? You don't have to, doesn't mean just take it and run with what I say, because that's not coachability. No. But what are some of those kind of good traits that you look for, as well as do I want to have a beer with you? Do I think this is going to be enjoyable? What are some ways for founders to show, hey, you should want to be on this journey with me?
I think being responsive is really important. If you ask for something, if it comes back a couple of weeks later, that's auto mute on LinkedIn because it shows you're not getting your ducks in a row. So the number of people, I had somebody message me, this is bonkers, had somebody message me a few weeks ago saying, I'd really love to pitch to you. I'm like, great, can you send me your pitch deck? And they were like, oh, I haven't got one yet. Right. Okay, well, I'm not going to offer you a conversation. There is angel investors have a reasonable expectation you will come to the party with your ducks in a row. And what do I mean by that? I mean pitch deck, forecast, term sheet, advance assurance, and probably some way of justifying your valuation these days. I would never have included valuation 2 years ago, but the world's changed. So I think that just being prepared, respecting your audience and their time, the people you want to find and speak to will be incredibly time poor. They'll be cash rich time poor, probably. And I had a ridiculous example example the other week where a founder sent me through 100 pages of documents. I said as a favour to somebody else, I said, yeah, I'll put £10,000 in as a token investment. And that was okay.
It's a nice favour.
Yeah, as a nice favour. And then the very next day, the founder was chasing me. They were saying, have you read those documents yet? And I'm like, no, I haven't read 100 pages. I don't think this is the investment for me. I just walked away because I thought that you've got to respect that your investor is going to be pretty busy.
And I do feel like founders forget to have the empathy for the investor.
Yes.
A little bit. I think it goes
both ways. Yeah, absolutely. And there is something around, I know founders, there are lots of complaints around investors ghosting founders. Yeah. Which I think is an interesting and fair point, and I think it's rude just to ghost people. I think, personally, I love giving feedback, even if an opportunity is not for me. I'd say, but it's hard. If you're an investor and I just don't like it, or I just don't like you, are really, really difficult words to say. And most...
And why would you say that? Because that doesn't even feel constructive, right? Like a token like you does. That's really hard one to expect someone to say honestly to you.
Yeah. I think there are other ways of dressing up. I don't invest in this space, or I've got an adjacent investment, whatever it happens to be. I do think that expectation's interesting, though, for founders to always get feedback, because the founders are just trying to sell something. They're trying to sell equity in their business. And how often do people have a conversation with a founder? The founder decides not to use your service or whatever. I don't really mind, but it goes both ways. Whereas there's a lot of complaint when the VC, it's typically a VC that gets complained about, just ghost the founder.
Yeah, and I think for me, it's a bit like in recruitment. It's like, how far are you through the process? How much time have you invested? How much of a relationship have you built? If we're on due diligence and you ghost me, I'm going to be pissed.
Yeah, that's bad.
But if we're at the first pitch event,
if I've sent you one LinkedIn message and you've ignored me, it's like, well, that's fair enough.
And I do sometimes try and temper founders who are being very quick to damn someone for not giving their time, because actually, as you said, investors are trying to assess the good ones are trying to assess so many opportunities. And it may be that you hit them at a moment when they're busy, like when their kid suddenly needs picking up from school, because there's so much humanness in this as well. And I think we forget that angel investors aren't businesses.
Yes.
Like, it's an individual trying to pay it forward, trying to invest. And actually, I think we're sometimes too quick to critique, because there feels like, quite rightly, this critique of the power imbalance. But I think in that we need to have a bit more empathy for, hey, it's an individual at the other end of the computer trying to apply to a lot of people.
Yeah, I think that's fair.
So if a founder gets the balance right between finding who the right target is, which is really tough, and reaches out, what are some tips, as well as already having your ducks in a line before you reach out? Yeah. Are there things, and I'm always really intrigued by your answer on this, because you answer very differently to lots of angels, but do you like someone saying, I'd like advice, or do you like the upfrontness of, I want your investment? What's your 2 cents on that piece?
I think it's very straightforward to ask for what you want. If you want investment, great, ask for investment. I'm all for cutting to the chase. I think building a relationship is important, and I will always give advice. One of the things I love about running FounderCatalyst is to be able to help so many founders achieve their funding. And genuinely, I don't care whether people become our customer or not. Yeah. I care about people getting to the right outcome, whether it's using a lawyer because you've got a really specific use case, whether it's using our competitor, or whether it's Charlie, who you had on your podcast a while ago. She's great at picking my brains, and she's used our ASA template, and she's done a funding round for free, and fair play to her. I just love the fact that we've been able to help her on a journey. I think that's really important to me. And we offer absolutely free advice on people. It's understand the context. I have conversations with 2 hats on. Yeah. I've chosen only to invest in our customers because I think it would be ridiculous to do anything else. But I'm very clear that when people are talking to me, and I've got a FounderCatalyst hat on, it's about that. And I love to understand it's really great working as a service provider to customers. And there are some I cherry pick and either decide to invest in because I think they're absolutely amazing. I've got to know them during the process. Yeah. Or, as you know, there are some we give pro bono support to. We've got half a dozen customers now that we have cherry picked because we love their mission. We realize they need just that extra little bit of support to get to where they're going to.
And it strikes me as well, coming back to the bootstrapping point, that by bootstrapping FounderCatalyst as well, you have the freedom to decide how you want to support these customers. I think if you'd taken in VC funding, you'd be under such pressure to scale this, to take yourself out of it. I don't see any VC going, yes, Sam, still take loads of one-to-one calls with founders and please give them advice in the process. You couldn't do that.
No.
Yeah, just curious on your thoughts on bootstrapping versus VC, because I think it's such a meaty topic. I've derailed us mid kind of going through the investor flow. Welcome to Hattie's ADHD brain, but really curious on this point.
Yeah, I mean, the VC funding is the very last thing that I would ever take. It's close enough to private equity that I'm like, yeah, I don't think so. I see lots of VC funded businesses in our space, and sometimes it works really well. I think probably less than 1% of business, VC's a perfect fit, where you've got a massively potential high growth business, you've got product market fit, all of your ducks in a row, and you need loads of cash in order to swing for the fences. I think there are loads of businesses where they would be better served by bootstrapping for the initial part of the journey if they can. And I realize I'm in a privileged position because I've had an exit that I can bootstrap forever, frankly. And then do an angel funding round and then find profitability and get that more steady and sustainable growth. And for me, that's a much more comfortable journey. And I'll never have to take VC funding, so I won't. And it's very intentional. I think it's a really interesting experiment. If you look at the startup space, there are loads of businesses in the startup space delivering services to founders and startup companies who they've done 7-10 million pounds and more in VC funding, and they're not profitable. They're on the treadmill, whereas actually I've got nobody to answer to, which is much more comfortable to me. And we can pick and choose who we help and how we help and what we do for free and what we charge for, and we can come up with a unique pricing model. Whereas I think as soon as we took on VC funding, it would be great. Well, you need to
charge more.
Charge more and stop doing your time for free and pour money into marketing and those things, all the things that I don't really want to do.
And I guess bring it back so that I don't totally derail us to this idea of finding the right investor for you. I think one thing I often encourage founders to try and learn in their conversations with angels is part of their thesis. Do they just back venture backable companies? Because some angels only want to back those who are going to go on their journey. Or if you've examined it and thought, you know what, I don't think VC is right for me, you might want to find an angel who is actually also aligned in that slower but more profitable growth, keeping more of the company amongst the early investors. Because actually also the more money you take, the bigger the sell at the end has to be to take away the same amount because you've just given away more of the pie. And so I think there are lots of angels like yourself who don't mind if you take VC or not. They just want to see you grow to an exciting point. So that's, I think, part of the due diligence more founders should be doing on their angels. You know, what do they think about this?
And lots of angels will be agnostic on that point. It's not something, if I think back to my early days of angel investing, it's not something I'd have naturally asked. I'd have probably asked about future funding rounds. That's just to check that the founder doesn't say, I'm going to grow a lifestyle business, and I'm trying to double check for that. But it's not something you'll hear angels asking very often, whether you'll be VC backable. And if you think angels have very low aspirations on an exit, they'll hope for 100 times return, they'll accept a 10 times return, knowing that actually with the fizzles and the tax relief, and you throw it all in a pot, actually they're probably going to get 3 or 4 times their money back on a large enough blended portfolio. And that's okay for most angels. Some of the businesses I've invested in couldn't have got to where they are without VC investment. So I've got a company, Rovco, that I invested in. They're doing a later stage investment round now, and it's way past where angel investors would be able to support. The only way they can get to scale and then potentially exit, I'm sure, is by using VC cash. But there are lots of other businesses where that would be a bad choice.
And so, again, coming back to that point where they've identified the angel, for you, the transparency and the outreach, I'm reaching out because I'm raising and you've got everything in a row. And you mentioned already that team is fundamentally what you're trying to assess. But before you take a meeting, what are the things that you're looking for? And my guess is, to your point earlier, they're going to be very standard among other angels of what you're trying to get a sense of in the pitch deck. And ultimately, I think founders often think of this as a tick box exercise and forget it's actually you've got to really excite someone. This is not just have you covered everything that we're saying, it's have you used that an opportunity to get an investor really behind what you're doing and wanting to learn more. What are the things that excite you in a pitch deck, not just the check boxes?
I think the checkboxes are important for me. So I want to see if you're deviating from what a normal pitch deck is. I review so many that jumps out as a bad thing instantly. So I want to see, and it's boring and formulaic. I want to see problem, solution, why you, why now, what's the team, what's the market size, who are the competition, what's the ask, blah, blah, blah. A very formulaic 14 slides. I want to see those, and I want to see them in vaguely the right order.
Yeah.
But layered on top of that, I absolutely want some personality. I want to really get to the heart of the team. And one of my pet peeves is you get to the team slide and there's no pictures, there's no LinkedIn link. It's just somebody's name. And you're like, that's not selling you as a team at all. I'm happy seeing team slides of 2 or 3 slides. If it digs down, this is the CEO and this is why he's going to ace the business. This is his team under him. This is the advisors all across 3, because it's so important. And lots of people just skirt over it. They don't bring any personality to it. And that's really frustrating from an investor point of view.
Yeah, team is normally the least thought about slide. It's like maybe they've got the picture and just the job title, and it's like, cool,
great, why you? Yeah, exactly. Whereas I've seen some done really well recently with logos where they've worked before, and just bringing a bit of personality there, because ultimately investors invest in people.
And I love as well when they go even a step further beyond logos and say, like, what did you actually achieve at that company? And I want it to be like your highlights reel of like actually has sold companies of this size millions, or whatever it is, has developed this for Siri.
Yeah, and the old, when you spot ex-Google on a team slide, I kind of shrug and go, I can't even guess how many people are ex-Google in the world, but it's probably a few million by now, isn't it?
Yeah.
There's lots of ex-Googlers, and that says nothing about you. It says nothing about what you did. It says nothing about the outcome. So I think you need a bit more personality than that.
I think the other one that I often see get sometimes missed entirely is the why now slide.
Yes.
What do you like to see on that one?
Yeah, I mean, some businesses, there genuinely is a why now. There is something that has changed, whether it's something AI or a new manufacturing technique or whatever it happens to be. It is, why is this possible now? Why has nobody ever done this before? And by the way, to be a successful business, you don't need to be creating something new. Fever Tree and those kind of examples are very standard examples of where you can take an established industry and do something slightly different and go on to dominate the industry. But yeah, why now should bring together, why is your team the right group of people to deliver now? And ideally you can link it to some technology change or a change in the market. There's so much disruption over the last few years with COVID changing the way everybody works. We're in a really interesting economic time. There's just so many changes, and technology is moving obviously at pace. If you can link your business, the why now, to one of those. But I think personally it's okay to say me and my team have the experience. And if I link it back to my own kind of journey, if I'd have started a business as an entrepreneur when I was 20, it would have been a horrible failure, I think. For lots and lots of reasons. I just wasn't anywhere near mature enough. I think you're building on all of that experience. When I started my entrepreneurial journey at 43, that was the right time for me, and I appreciate it may be different for others. But if I was doing a why now slide for me, it would absolutely be that. It would be layering on top of all of that experience for the now.
And I think it's the other part that founders miss, is it comes back to the storytelling. And that's about building that sense of you and what drives you, and getting excited about coming on the journey with you as well.
Yes. And having a passion, I think lots of founders miss that passion on why they care about this as a problem.
Okay, let's say they nail the deck. What happens next? I think a lot of founders are kind of like, what happens once you say you want a call? What should they expect on an angel investor call?
Now's probably a good time to say that I think chasing individual angels is a path to heartbreak. Genuinely. I think everybody should do it for a few months just to cut their teeth on it. But it would be heartbreaking for me as a founder if I was chasing. Because if you do the maths, there are hundreds of thousands of angels in the UK. Maybe 1 in 20 you pitch to, you get the right person who likes your proposition at the right time, at the right valuation. And then you've got to string a lot of ands together to get a yes. Call it 1 in 20. Say you're raising £250,000, which is the average according to Bowhurst. And each investor is going to put 25k in. You can do the maths. You need to have hundreds and hundreds of conversations in order to find your set of angels who are going to invest. There are lots of people who take that hard path, and fair play to them. I probably wouldn't do that if I were fundraising. I think the optimal way of fundraising in the UK, and at the other end of the scale, you've got SCIS funds and VCs, and they come with their own challenges. Don't get me started.
I'm going to get you started in a minute.
Damn it. But the optimal for me is angel groups and private equity clubs, because there's about 100 in the UK. They are collections of angels who typically invest together. For my first couple of investments, I wouldn't have had the confidence to invest potentially, which seems ridiculous saying it 6 years down the line, but I wouldn't have invested. But I was new to it, and actually people around me, and I watched them doing due diligence on the business, how they spoke to the founders, the kind of questions they asked. I'm like, oh yeah, I have confidence in investing in that. So if I were a founder looking for funding, I would absolutely speak to as many private equity club and angel networks out there. There are 100. We've got an interactive map I can send a link to that.
We'll put that in the show notes.
Yeah, that people can go and hound each of those groups. The benefit of that is you get to pitch to 20, 50, 100 people at a time. Your chances of doing 2 or 3 pitches to some of those groups and then getting a successful investment is relatively high compared with hitting individuals. Now, there is a trade-off here.
Yeah.
You're trading off time and cost because most of those groups charge between 5 and 7% of whatever you raise via that group, which for lots of founders, I think that is a trade-off well worth making.
And we see it with individual brokers as well, right? They'll charge about the same amount for introductions. So obviously I'm a huge fan of angel syndicates as well. And we're both very aligned on that's a massive way to drive change in the system. And just for anyone listening as well, the thing I always say is you can normally search for angel syndicates on 2 kind of different barometers. One is founder identity. So there are lots of angel syndicates that invest only in female founders, for example, or Black founders. And then there's also the kind of space you're operating in. Lots of green, climate-focused angels. I always say have a Google through both lenses.
Yeah, and also the geographic angle. Lots of the angel groups love supporting.
They're very important.
Yeah, love supporting local companies as a preference. I think that's really important. If you're London-based, then we know some of the inequalities in the startup space by gender, ethnic diversity, but also geography. If you're based in London, it's much easier to get. So I love that lots of the groups have a very strong preference for investing in their own geography. I think that's really important. Yeah,
and you can normally search it. There's often like Southeast Angels, and then there'll be even more local ones within.
Yeah.
So yeah, you're right. Geography is a pretty key one. Okay. I'm so sorry, Sam.
Here we go.
You said don't get you started. Look, we often get asked if we raise. People are looking at some of the SEIS funds, particularly in the early stages, and they often ask us, what do you think? And we always go and put an ear out to the ecosystem, founders who've been through them before, people like you who will tell us all of the things to be aware of. But I think for founders listening, what are some of the things that they should be really wary of? You said that in your mind, a kind of 5 to 7% fee is actually a fair one to trade off for your time. What are some of the trade-offs you wouldn't recommend founders making when it comes to raising, particularly from things like certain SEIS funds, who we won't name, but...
No, we won't name. We've got an article on this where I'm sure we can put it in the show notes. And so for people that don't know, your term sheet at a very early stage is usually produced by the founder. So later stage, when you take VC investment, the term sheet is produced by your investors. At a really early stage, the founders are responsible for producing the term sheet. But then you go to the SEIS funds and they will give you a term sheet.
And term sheet is essentially literally the terms you're agreeing to. It's like the contract.
It's a distilled version of the contract. So your funding round legals will typically be 100 pages of documents. Nobody's got time to read that during initial stages of DD at least. So there's a term sheet which distills that down into 3 or 4 pages. And it's the key things that both founders and investors are agreeing on. Creates a lovely anchor for future negotiations. And at the very founder-friendly end of the scale, you've got family and friends rounds and individual angels. They're not going to be that sophisticated. That's not to say to exploit that, but the terms are going to be really founder-friendly. And the thing about when I say founder-friendly and investor-friendly, it's a zero-sum game. When an investor's winning a term, the founder's losing. It's pretty much win or lose on all of these. Right at the start of the journey, you will have a very founder-friendly, if you do family and friends and normal angels. When you go to private equity club and angel networks, it will get a bit more investor-friendly. They'll ask for information rights and investor consents, maybe a board observer, those kind of things.
And can you just briefly explain what those are for anyone who has no idea what they mean?
So information rights, for example, is an obligation on each of the founders to update the investors regularly. So quarterly updates or whatever. It feels quite fair. Don't even get me started on how few of my 30 investments do quarterly updates. I will usually get an update every couple of years going, great, we're fundraising. Do you want to put more money in? And by the way, if I haven't heard from you for a couple of years, the answer's a polite no, because it's
a really big mistake founders make.
Yeah.
Why would you not manage your existing investors to make your life so much easier on the next round?
Because quite often your later investors will want to speak to your earlier investors. And if the update is, well, I haven't heard from them in a couple of years, I don't know what's happening, that's not great optics.
So what should founders be really wary of when it comes to starting to see investors take on their side that it could seem really innocuous, but actually we talked about information rights being a kind of fair one. Yeah,
very fair. And you've got investor consent, which splits the crowd really. I think as an investor who feels hard done by one of my investments, I'll dive into that one maybe. I would always insist on investor consents. And this basically means before you do any big action in the company, you ask your investors for permission. And as long as it's not ridiculous, if you want to raise more money at a reasonable valuation, or you want to take on some debt, or do anything reasonable, your investors, if it's in the interest of the business, your investors will approve it. And the reason why I personally insist on that is I invested in a business. I put about £40,000 in total over a couple of funding rounds. And I found out that they had closed the business down via a company's house filing by accident, which is really bad. I know we hear lots about bad investor behavior, but sometimes founders aren't angels either. Excuse the pun. Yeah, and that was a pretty harsh lesson for me. I thought I got on with the founding team really well. We were very supportive. I was one of their lead investors, and to find out that the company was closed by accident was like a ouch. And if there were investor consents in place, they legally couldn't have closed it without my consent. Otherwise, I can sue them for breach of contract, which I'd never do. But yeah, so investor consents is about 50-50. I think if you're getting individual angels, they usually won't insist on that because they may not know of it, or they don't have the power to do that. Virtually all of the angel clubs and anybody onwards from there will be sophisticated to know that that is a good thing.
So that's the reasonable ones.
Those are the reasonable ones.
What are the slightly more extractive?
Yes.
You say.
And I used to think when I started investing, I thought SEIS was a great leveler. You go, well, you're not allowed those VC type terms. You're not allowed liquidation preferences, anti-dilution or non-diluting shares. Most people won't know what they are, and hopefully will never learn. But they're very VC, they're very investor friendly, and there's some real calamity stories. I think FanDuel's the best one for a liquidation preference, for example, where a VC put a couple of £100 million into a business that was worth $750 million. The valuation tanked, and the VCs forced the sale of the business and took all of their money out and their money again, leaving the founders and early investors with nothing. So liquidation preferences are very VC style things.
It basically means when the shares liquidate and you can actually take the money out, they get to go first.
Yeah.
You get whatever's left.
And they double dip as well. So they go first and they go second, and then you get what's ever left. In that example, the business sold for about, I think it's $350 million. The founders, the early stage investors, and even the early stage VCs didn't get a penny. It's such an amazing story in a bad way.
Yeah.
I used to think they're just not compatible, and therefore it protects the founders. That is true to some extent, but there's still a lot of flex that the SEIS funds particularly make use of. And they know how to play the game. The SEIS funds, their job is to play the game better than anybody else. And they understand that things like forcing founders to invest if there's any director's loan account, they've got to convert their director's loan account at the funding round at the same valuation as everybody else. So if you've got 100 grand in director's loan account, that's going to be really painful, because the most tax efficient way of a founder getting money back out of the business is repaying their own director's loan account. And they take that off the table. Lots of the SEIS funds, I don't want to overgeneralize here, but they will force you to create an option pool before the funding round. After the funding round, now optimal for the founder and market standard is the founder closes, or the startup closes, 1 or 2 funding rounds, and then you create a 10% option pool.
Which is basically for future employees.
For employees and advisors and things like that. And that's good for a founder, and it's fair generally because the founder's sharing the dilution with other people. Yeah. The SEIS funds love to get that done before a funding round because the founder's taking 100% of that 10% pain rather than sharing it with anybody down the line. And then you get onto things like liquidation priorities. So liquidation preferences aren't in any way compatible with SEIS, but funny enough, the SEIS
priority sounds like a synonym for preference.
Yeah, it does. It sounds like a bad thing, and it is for a founder. It basically means that in a failure scenario, effectively, the funds get their money out first. Right. Ahead of the founders, which I can get, but it's also ahead of every other investor who's invested in that round, which isn't a great look, and so on. And the fee structures on the funds, they're painful in one or two ways. Yeah. So either they're 10 or 12% plus VAT of fees, which is eye-watering and painful. Some of the funds also insist that they have an option or warrant in your business as well, which is a non-diluting instrument. This is going to be too complex for this show, I'm sure, but it basically means that they own 2% of your business, no matter how, or whatever percent, no matter how much additional investment you get over a period. Yeah. And that's really unattractive to VCs and other investors. And what that might mean is your VCs just walk away to say you have non-diluting shares there that are additionally painful to us, or they'll bake it into their calculations and they'll say, right, we're going to build an instrument equivalent to that, so that doesn't disadvantage us to some extent.
And then it takes from you, the founder.
And the founder's paying the price of that at every stage.
And so I think it is worth, as founders, just being aware of these things so you can actually know what to take seriously and not take seriously. As some of the earlier information rights where you probably not going to bother fighting it versus where you actually might want to really negotiate. And I think people often forget with these kind of funds, you can negotiate term sheets. Like if you're in a stronger place.
You can with some of them. Lots of the funds are, it's a numbers game. They make as many investments as they can, and whether they invest in you or not doesn't really matter. When you're making 100 investments a year, they're not emotionally attached to investing in your business. So lots of the term sheets are take it or leave it. You can't negotiate. And if I were a founder fundraising, I would look at every option before an SCIS fund. I would exhaust every single private equity club and angel network. I would speak to the brokers and the introducers. I think some of those do an absolutely amazing job.
They really do.
I would speak to individual angels. I would exhaust every opportunity. That would be my funding of last choice, because it is financially painful. The percentage they take in terms of the raise, the fee they take will be high, but also the terms are bound to be worse than you get with any private equity club or angel network.
So coming back to closing the deal, whoever you're doing it with, hopefully with someone with fair terms, let's talk a little bit about valuation and also lead investor. And you mentioned that you're the lead for some of the companies that you invest in. I think this is something that really often throws founders. So maybe we can talk about one, setting and negotiating a valuation, and maybe in that context introduce the idea of a lead investor and what they are and why you need one, how you find one. Because I think often that's when founders start to realize they need a lead investor, when no one will agree the valuation with them without someone else to do it.
Yeah. So let's start with what a lead investor typically is. And I think there is no real standard here. Some deals have no lead investor. Some deals just happen organically without one. And some deals are absolutely helped with one in place. So normally a lead investor will be the most material investor in a funding round. So if there's a 250 grand raise, they will put in 75,000 or something towards that. So they'll really get the ball rolling. They will negotiate. They will typically do the due diligence, and ideally they will share that with others because everybody's having to do the DD from scratch. And they will set the deal terms, so what the term sheet terms are, whether there are information rights, investor consents, and those kind of things, but also crucially the valuation. And as we mentioned earlier, the valuation in a really early stage business is actually ridiculously hard to do. A founder's worth, my business is worth millions, and the investors will be like, there's so much risk baked into your potential that they're going to argue for a much lower valuation. We've actually got an article that deep dives into my thought process on valuation, and it's really straightforward. If you're pre-seed, pre-revenue, what does normal look like? Well, you look at Bowhurst, the average pre-seed, pre-revenue valuation is 1.5 million, and you start with that, and then you look through the chart of, is it a really strong founding team? Multi-exited founders, ex-Google for what that means, and you add things to that. If it's a solo founder, their first rodeo, then you maybe detract a bit from 1.5 million on that point specifically. Then you look at, is there IP? Are there patents? Is there some secret sauce that makes this a unique thing, or is it just relying on something else about the business? And if there is a patent or other IP that's protectable, great, you'll add another bit to the 1.5 million. Then you look at the competition, and then you look at you walk your way around all of those aspects of the deal, and you will end up at a number. And for a very average business with a team that hasn't done much before, solo founder, you're maybe looking at £1 million as a minimum, and the sky's the limit if a business is AI. But removing the outliers out of this at the moment, ignoring the outliers, your normal will be 1.5, flexing up to maybe 2.5 million if you've got an exited founder with a really great idea with patents behind it. The lead investor will be involved with driving that valuation, and most of your follow-on investors that fill up the round beyond the 75 to the 250, they should firstly take the due diligence as read, though quite often you'll kick the tires or you'll want to read it anyway. Most investors will then largely agree to the terms that have been agreed, as long as they're not ridiculous, and ditto the valuation.
Nice. And so I guess a question on the valuation, because I think lots of founders listening will be going, that sounds quite a lot like you need quite a good sense of what things are worth from having done as an investor, particularly if you're going to be a lead investor. To your point, you're not doing that it's your first investments, right? You know how this works. You have a real sense of what things are and aren't worth. As a first-time founder, particularly, that's so hard to do, right? How do I know what to add? How much do you think founders should, if they can find the right investor, what stage do you think they should get towards their valuation themselves? And then how much can come in the negotiation, i.e. what level of logic do they need to have behind the valuation? How much would you expect it to move? I guess to those listening thinking, I'm really struggling to get there and I almost don't know whether to wait or go and get some extra help first, or what would you expect from a...
Yeah, so lots of the accelerators offer great advice here. This is one area specifically where I think those accelerators are great at lending a hand and providing some science.
Yeah.
There are tools online you can do analysis. Now, lots of those tools are very good when you get to revenue. So they'll do discounted cash flow and VC methods. They're not so good at the low end.
You often need quite big revenue, even if you're listening thinking, I have some revenue, like no big revenue.
Yeah, still solid revenue. And for the lower end, there's scorecard and Berkus methods, which are well recognized. But both of those rely on you saying, what does normal look like? Yeah. And normal looks like 1.5 million. That is your starting point for evaluation. Every founder wants it to be higher. Every investor, I wouldn't even say they want it to be lower than 1.5 million. They just want it to be reasonable based upon the business. If I can give you one example of what not to do, I saw a business pre-seed, pre-revenue, no product built, so they were raising to build a product. Yeah. This is going back 2 years ago, so that's not such a ludicrous proposition, though the rest is. And they had paid an accountant, bless them, to do a valuation prediction. And they used Berkus, DCF, and discounted cash flow and VC, all three of them. The DCF and the VC came to about 400 million. Both of those came to roughly, plus or minus. And the scorecard came at something reasonable, like 1.5 or whatever. And my guess would have been for that business 1.5 million. But the accountant didn't think, this is something very wrong with this methodology. They did a weighted average of the three, which came out with a 200 million valuation. Which is just ridiculous. I mean, if you just compare that anywhere near market standard, you won't be surprised to hear that founder didn't get funded. But there is some common sense from the founder point of view. They were going, well, my accountant said this. And I walked them through the process of how that was just bonkers, but they were unwavering in there.
And I think thinking about those benchmarks is really important. And if you can, speaking to other founders about what they had in place when they raised is maybe a good way to start to get that sense of what's realistic and pragmatic.
Oh, and what was the other amusing thing about that example? They were only raising £75,000.
Oh my God.
So
they're giving away 1%.
It was 0.05% of the business. And by the way, here's a tip for all founders watching. There's another lens by which people will look at your raise to make sure it's sane. So you've got, basically it's a triangle of three numbers that all interact. You've got what's your valuation, what's your raise amount, and then you've got the dilution percentage, which is the thing that falls out of the other two usually. And your investors will be sanity checking that numbers between 15 and 20%. Yeah. If it's much higher than 20%, you've got a problem because you're over diluting, which means that bad things can happen in a later funding round, or you just won't get later funding. And if it's much below 15%, then investors will know your valuation's too high. So just sanity check. You can do this at home with a calculator. Just sanity check you between 15 and 20%. It doesn't mean you're right, but it means you're not.
You don't look ludicrous on that.
Yeah. By that metric.
And I think that's worth thinking about, as well as a lot of founders give up too much of their business too early. They undervalue themselves.
Yes.
Lots overvalue themselves as well, but a lot undervalue and actually do give away huge chunks of equity. And as you say, good investors won't want that either, because they'll know that you won't be able to raise the next rounds. But later investors go, well, you've just not got enough skin in the game for you to keep chasing this.
Yeah, and I've been bitten by that myself as an investor, so I'm very aware of that. So I invested, no names, I invested in a business that I love, by the way. I absolutely love the business still, despite this pain. I invested in a second funding round. They did a couple of rounds after that and then went to America to do a very serious VC round. And the VC's first comment was, the founding team is underrepresented on the cap table. Yeah. So they wanted to recapitalize the founders, which is as much fun as it sounds. Yeah. So what that meant was double pain for all of the existing investors. So the first thing they did was recapitalize the founders before a funding round. So the founders got magical new shares, which, by the way, only impacted existing investors, i.e. me. Yeah. And then the VC came in with a whopping great big investment, so it's double dilution.
Wow.
And that's why, as an early stage investor, you shouldn't be overly stealing too much, because it's just going to get corrected at that point anyway.
Yeah, that's a good way of looking at it. Somehow we've run out of time.
Wow.
2 final questions I ask every guest. First question, as a founder, and I suspect this is going to come from Founder Catalyst, but it can come anywhere in your founder journey. What are you proudest of?
What am I proudest of? I think genuinely proud of proving what you can do in a bootstrap business, and we will continue to do that. We're never going to take external funding, and I genuinely believe, completely and absolutely believe in what we're doing, the good we are doing. It's not, for me, it's not about the financial reward. It's also about helping as many founders as we can via education and free resources and pro bono rounds and things like that. So yeah, I think that's absolutely what I'm proudest of.
Love it. And finally, the best piece of advice you've ever been given.
This doesn't relate in any way to FounderCatalyst that I can think of, actually, but I remember, and you won't believe this, Hattie, but very strong-willed. Crazy.
Resonate, Sam.
And I just started delivering projects, and I was on a monster project. And like, my inclination, I have a massive sense of fairness, and I still carry that to this day. And my massive sense of fairness couldn't let the customer win on a few points because they were wrong. They were fundamentally wrong in what they were saying. And my boss at the time took me aside and said, you can win this battle, you will not win the war. Sometimes you need to know when to bite your tongue, when to give, when to just not fight to the death on every single thing. And actually, I think, believe it or not, I've mellowed a lot.
I love this. I mean, knowing how you sometimes choose new features for FounderCatalyst, I believe you're still fighting a lot of battles, but you are winning the war. And I do think you're doing it very deliberately for how to make the impact for founders. So for anyone listening, we will put a ton of resources in the show notes. Sam, if you can share your favorite links and articles that you think are most valuable, we'll pop them in there. Follow Sam on LinkedIn. He shares so much advice regularly that is really worth following. And if you need help with your funding round, you know where to go. Sorted. Thanks, Sam.
Amazing. Thanks for having me. It's been amazing.
Thank you for listening. Before you go, please do take a minute to follow so you never miss another episode. We have some incredible founders coming up. And I always love to hear what resonates with listeners. So do drop us a direct message on Instagram @NotMyFirstGuest with any moments that meant something to you, ideas for future episodes, or your own entrepreneurial stories you want to share. Until next time, happy startupping.